In the same window of time, on three different continents, three completely different layers of the global financial system made the same decision. A 160-year-old French bank, one that has continuously operated through two world wars, the entire gold standard era, and the creation of the euro, deployed a regulated stablecoin on the XRP ledger. South Korea ran the first real-time tokenized government bond settlement in its history on Ripple infrastructure. And Japan demonstrated that XRP cross-border settlement runs roughly 60% cheaper than the legacy correspondent banking network and clears in under 4 seconds. Three countries, three continents, three different layers of the financial stack, all converging on the same infrastructure within the same news cycle. And the Moonboy crowd reduced it to a single question. Will it pump the price this week? What I'm about to walk you through is not being explained on the news, it is not being explained on the major XRP channels, and it is being completely buried under thumbnails about the spot chart. Let me pull back the curtain on what these three announcements actually mean when you stack them together, why a 160-year-old French bank specifically added the XRP ledger after already operating on Ethereum, Solana, and Stellar, and why a Korean insurance company moving government bonds onto Ripple custody is the most underreported story in finance this year. The world missed the signal again. We are going to fix that today. Welcome back. I am the Calm Analyst, and on this channel we do not chase pump dates, we do not promise Lambos, and we do not sell you fantasy. We decode infrastructure, we read the filings, we follow the math. Today we examine three converging events that, taken together, mark the moment XRP stops being treated as a regional crypto asset and starts being treated as global financial infrastructure. Sit back. Let's get to work. Let's start with the hard truth. About 95% of XRP holders are still treating each piece of news as an isolated event. They see the French bank story. They retweet it. 3 days later, they see the South Korea story. They retweet it. A week later, they see the Japan settlement data. They retweet that too. And in the process, they completely fail to recognize that these are not three separate stories. They are one story, told in three different jurisdictions, on three different layers of the financial stack, in the same window of time. That is not coincidence, that is convergence. And convergence in financial history is what happens immediately before a structural revaluation. Let's start with France, because this story carries the most regulatory weight and is the most underestimated of the three. Société Générale was founded in 1864. To put that in perspective, when this bank opened its doors, the United States was in the middle of the Civil War. It has continuously operated through both world wars, the rise and collapse of the gold standard, the creation of the euro, the 2008 global financial crisis, and the entire digital transformation of European banking. It is, by every regulatory definition, a systemically important financial institution, the kind of bank where if it makes a reckless decision, the French government, the European Central Bank, and the entire EU regulatory apparatus pay attention immediately. This is not a fintech startup. This is not a crypto-native firm making a speculative bet. This is a 160-year-old institution with 25 million customers and a direct line to European regulators. And its crypto division just deployed a regulated euro stablecoin on the XRP ledger. Now here is the detail that almost nobody is highlighting correctly. Société Générale did not choose the XRP ledger as their first or only blockchain. They already had the same stablecoin live on Ethereum, on Solana, and on Stellar. They evaluated every major piece of public blockchain infrastructure available to them, deployed on 3 of them, and then specifically added the XRP ledger to the list. That decision did not happen because someone at the bank thought XRP was interesting. That decision passed through legal review, compliance committees, risk management oversight, and technical architecture evaluation. It is the result of a 160-year-old bank's institutional machinery looking at the entire universe of available blockchain infrastructure and concluding that the XRP ledger meets a specification that the others do not fully cover, and the product they chose to deploy is MiCA compliant. To understand what that means, you need to understand that MiCA, the Markets and Crypto Assets Regulation, is currently the most rigorous, comprehensive crypto regulatory framework anywhere in the world. To be MiCA compliant, a stablecoin must meet strict requirements around reserve backing, governance, transparency, and consumer protection. So when you stack the pieces together, what actually happened is this. A systemically important European bank deployed the most stringently regulated category of digital asset onto the XRP ledger after evaluating every alternative. Stop and think about what that tells you about how the institutional layer of European finance views this infrastructure. Not speculative, not experimental, regulated, compliant, built to last. To understand why this matters, you need to understand a concept most retail investors have never absorbed. Stablecoins on the XRP ledger are not in competition with XRP. They run alongside it. Every stablecoin transaction on the XRP ledger consumes a small amount of XRP as the network fee. Every time the Societe Generale Euro stablecoin moves between wallets, every time a payment is settled, every time a corporate treasury rebalances, a fraction of XRP is consumed. At institutional scale, with a 160-year-old bank operating through it, that produces consistent, ongoing, utility-driven demand for XRP from activity that most retail investors are not even aware of. The bank is not buying XRP as a speculative position. They do not have to. Their stablecoin running on the XRP ledger means XRP is being used every time it moves. That is utility-driven demand built directly into the infrastructure of one of Europe's oldest financial institutions. The crowd is asking, did Societe Generale buy XRP? The calm analyst is asking, what does it mean when a regulated MiCA-compliant Euro stablecoin runs on the XRP ledger and burns a tiny amount of XRP every single time it transacts? Those are not the same question, and only one of them survives a 5-year time horizon. Now let's move to South Korea because this story is going to look obvious in hindsight in a way that almost no one is processing in real time. Ripple just partnered with Kyobo Life Insurance to run South Korea's first ever real-time tokenized government bond settlement on blockchain, using Ripple custody. Let me break down every word of that sentence, because every word matters. Kyobo Life Insurance is not a small company. It is one of South Korea's largest financial institutions, managing hundreds of billions of dollars in assets on behalf of millions of Korean policyholders. This is the kind of institution that holds government bonds as its core reserve asset, because government bonds are considered the most conservative, safest investment that exists in modern finance. Insurance companies do not hold government bonds because they are fashionable. They hold them because regulators require them to, because actuarial models depend on them, and because the entire promise of paying out future claims rests on the predictability of those reserves. Now think about the significance of which asset class moved first onto Ripple infrastructure. If you want to understand where an innovation is actually going, look at what asset class it starts with. Speculators experiment with the riskiest assets. Institutions deploy the safest ones first, because those carry the lowest reputational risk if anything goes wrong. When a Korean insurance company chooses to run its first tokenized settlement using government bonds, the most conservative asset class on its balance sheet, that is not an experiment. That is a structural commitment. Insurance companies and pension funds do not run experiments with their safest assets. They run pilots that they intend to scale once the results confirm what they already believe is true. And they specifically chose Ripple custody, not a generic blockchain, not Ethereum, not a central bank digital currency platform. Ripple's institutional-grade custody infrastructure is now being used to settle South Korean government bonds in real time. Real time is the other piece of this announcement that deserves more attention than it has received. Traditional government bond settlement runs on T+1 at best in many markets, T+2 in others. That means if you buy a government bond today, you do not actually own it in your account until tomorrow or the day after. Capital is tied up during that window. Counterparty risk exists during that window. The entire global infrastructure of correspondent banking, clearinghouses, and custodian intermediaries exists specifically to manage that settlement window. It is expensive, it is slow, it is fragile, and it ties up an enormous amount of working capital that produces zero yield. T+0, real-time settlement, means the bond moves and the cash moves at the same time, instantly, with cryptographic finality. No window, no counterparty risk, no idle capital. That is not a marginal improvement. That is a structural change in how one of the most important asset classes in the world gets settled. And the first jurisdiction in Asia to deploy this in production is doing it on Ripple infrastructure. Ask yourself a brutal question. Does a Korean insurance company managing billions of dollars of policyholder reserves move its safest asset class onto a custody infrastructure it does not believe will exist in 20 years? Absolutely not. Insurance company asset allocations are multi-decade commitments. The fact that they are willing to use Ripple custody for tokenized government bond settlement tells you exactly how seriously this technology stack is being treated at the highest levels of Asian institutional finance. Now let's add Japan. Japan has been quietly running real-world data on XRP cross-border settlement for years. The numbers that just got publicly confirmed are not opinions. They are operational telemetry. XRP settles cross-border payments in roughly 60% less cost than the legacy correspondent banking network, with finality in under 4 seconds, and it has been made spendable for 44 million Japanese consumers. That is not a pilot population. That is roughly the population of California, Texas, and Florida combined. That is not the early experiment. That is production deployment at national scale. Now zoom out and stack the three pieces together, because this is where the actual story finally becomes visible. Japan is the payments layer, the proof that XRP works as actual money for tens of millions of consumers, settling faster and cheaper than the legacy rails. Societe Generale is the digital currency layer, a regulated, MyCA-compliant euro stablecoin running on the XRP ledger, burning XRP as fuel with every transaction. Kyobo Life Insurance is the real-world asset layer, institutional-grade tokenization of government bonds with real-time settlement on Ripple custody, 3 layers of the global financial system, 3 different countries, 3 different continents, all onboarding to Ripple infrastructure within the same window of time. This is not a coincidence. This is a pattern. And patterns of this magnitude do not emerge from multiple independent actors making unrelated decisions in parallel. They emerge from years of quiet infrastructure, building suddenly becoming visible all at once, because the regulatory environment, the technical readiness, and the institutional confidence all cross their respective thresholds at the same moment. What you are watching is not 3 news stories. You are watching the moment a multi-year, multi-jurisdiction infrastructure rollout finally surfaces above the waterline. Now let's do the math, because this is what gets glossed over in every viral video about these stories. The global cross-border payment market processes roughly $150 trillion every year. The European stablecoin market is in the process of being formalized under MyCA, with regulated euro-denominated digital assets projected to scale into the hundreds of billions over the next several years. The global government bond market is approximately $130 trillion of outstanding debt. The tokenization migration of government bonds, even at low single-digit penetration, represents trillions of dollars of asset flow that will need a settlement layer. Now apply a conservative number. Forget the moon boy fantasies. Let's say the XRP ledger and Ripple's custody infrastructure capture even a small fraction of just one of those 3 flows, not the majority, not the dominant share. A fraction. That fraction, applied to flows of this magnitude, generates settlement volume that has to clear through a finite token supply with shrinking tradable float. The total XRP supply is 100 billion tokens. The majority is locked in escrow with controlled monthly releases that are largely relocked. A meaningful fraction is held by long-term holders who have not moved their tokens in years. A growing portion is being absorbed into ETF wrappers, corporate treasuries, and now stablecoin operating reserves. And exchange reserves, the float that is actually available for purchase, has been on a multi-year drawdown. This isn't a prediction, it's a requirement of the math. If you want to clear meaningful payment flow, stablecoin transaction volume, and tokenize government bond settlement through a finite token whose tradable float is shrinking, the unit value of that token has to expand to absorb that flow without breaking the order book. That is not opinion. That is the operational physics of how settlement assets behave when demand crosses a structural threshold. If you have a problem with these numbers, you do not have a problem with me. You have a problem with the laws of finance. Now, I want to put a single piece of context in front of you that should reframe how you read this entire phase of the cycle. The institutions making these decisions are not paying attention to the spot price. Societe Generale did not deploy a regulated euro stablecoin on the XRP ledger because XRP was at a particular price last Tuesday. Kyobo Life Insurance did not pilot government bond settlement on Ripple custody because of a chart pattern. Japan did not roll out XRP-based remittance to 44 million consumers because of a trader's prediction. These institutions are making generational infrastructure-level decisions based on technical specifications, regulatory compliance, and long-term strategic positioning. The price chart is invisible to them. The infrastructure is the only thing that matters. This is calculated positioning by allocators and operators who are not gambling. They are building. While retail investors complain about a sub-$2 spot price, the global financial system is being quietly replumbed underneath the asset in real time in jurisdictions that span 3 continents. The price is the lagging indicator. The infrastructure is the leading one. We are watching the structure get built. The candle will follow eventually. Now let me map the timeline honestly. In the next 6 months, expect more announcements like the 3 we just covered in more jurisdictions, on more layers of the financial stack. not because they are coordinated, but because the technical and regulatory thresholds that gated them are finally being crossed in parallel. Each new announcement compounds the credibility of the last one. Each new institution that deploys reduces the perceived risk for the next institution evaluating the same decision. That is how institutional adoption actually works. Not in a single dramatic moment, but in a chain reaction of validation events that, in retrospect, define the moment the asset class crossed from speculative to systemic. Throughout this year and into next, expect the regulatory environment to continue converging in the same direction. The European MiCA framework is now active. The United States is in the final stages of market structure legislation. Asian jurisdictions are building digital asset frameworks in parallel. Each regulatory unlock removes another layer of friction for the next institutional deployment. And the institutions that have already deployed, the SocGens, the Kyobos, the Japanese banks, are already accumulating operational experience that will make their next, larger commitments lower risk and faster to execute. Looking out toward the back half of the decade, what we are watching is the first phase of a multi-decade migration. Payments today, stablecoins today, government bonds today. Tomorrow it is corporate bonds, structured products, real estate, commodities, equities. Every asset class that currently settles through legacy rails is a candidate for migration. And the infrastructure that has already been validated for the first wave of deployments has a structural head start over any infrastructure that has not. When the catalyst arrives, when a critical mass of these layered deployments tips the system into full migration, the current limitation vanishes. The risk premium that is currently suppressing the price gets stripped out, and the gap between settlement tier valuation and the current speculative tier price closes, sometimes violently. That is what every previous infrastructure adoption cycle in modern financial history has looked like, and there is no reason this one breaks the pattern. Now, I want you to think about what this means for accumulation, because this is where the practical implication actually lives. We are moving from an era of XRP abundance to an era of XRP scarcity, and most people will not realize the transition has happened until it is already over. Every institutional integration is a supply removal event. Every stablecoin operating reserve removes float. Every Ripple custody deployment locks tokens into multi-decade institutional commitments. The float keeps shrinking. The infrastructure keeps building. The institutional pipeline keeps loading. And the spot price keeps doing what spot prices always do during these phases, chopping sideways, frustrating retail conviction, shaking out the impatient. Here's what nobody wants to say out loud. Once a token enters a regulated institutional infrastructure layer, whether as part of a stablecoin reserve, a custody position, or a settlement liquidity pool, it does not come back to the open market for a 10% profit. It is structurally embedded. Every announcement, like the three we just covered, is mechanically a permanent removal of float from the tradable supply. The window for accumulating whole tokens at current prices is not infinite. It does not close on a specific date that I can give you. It closes when one of two things happens. Either the institutional adoption accelerates faster than the order book can absorb at current levels, or the supply absorption simply outpaces the float that is willing to sell. Whichever happens first ends the window. The institutions, the central banks, the sovereign treasuries, the systemically important banks, they have spent years quietly preparing. The retail crowd has spent those same years getting shaken out by chop, by FUD, by sideways months that feel like they will never end. That is not a coincidence. That is how every major asset reclassification in modern financial history has played out. The patient holders who understood the structural story end up on the right side of the revaluation. The impatient holders who treated this as a trade end up as the exit liquidity that funds the entry of the informed. I know it is hard to watch a sub-$2 spot price while a 160-year-old French bank is deploying regulated stablecoins on the XRP ledger, and a Korean insurer is settling government bonds on Ripple infrastructure. I know the chart looks like it is mocking your conviction. As an analyst, I am trained to distinguish between noise and signal, and I want to be honest with you about something. The current price is not the asset's verdict. The current price is the residual reading of a market that is still partially gated. The infrastructure is being built, deployed, and operationalized faster than the market is repricing it. That is a suppressed read, not a settled read. Being early feels exactly like being wrong, right up until the moment reality catches up. The boredom you feel right now, the frustration with sideways action, the headlines that say nothing is happening, that is the calm before the systemic reset, not evidence against it. The question is not whether the price recovers. The question is, who is still holding when three continents worth of institutional infrastructure becomes properly priced into a single asset? I cannot tell you what 1000 XRP will be worth in 5 years. No honest analyst can. What I can tell you is that the infrastructure being built underneath this asset in three different countries on three different layers of the financial stack is consistent with a global settlement tier valuation, not a speculative tier valuation. And the gap between those two tiers is exactly where the holders who paid attention get rewarded. Stack what you can responsibly afford. Plan around your real life, not around a fantasy, and distinguish between the noise of the day and the signal of the structure. Let me close with a single thought. The crowd is watching the spot price. The calm analyst is watching the moment a 160-year-old French bank, a Korean insurance company, and a Japanese remittance network all converged on the same infrastructure within the same news cycle. One of those views fits in a tweet. The other one fits inside the foundation of how the next decade of global finance gets settled. Price is a distraction. Convergence is the reality. One is a candle. The other is a category change. History does not reward comfort. It rewards the people who paid attention while the room was loud about the wrong thing. If you made it to the end of this analysis, drop the word convergence in the comments. I want to see who actually understood what just happened across three continents in the same week, because that is the audience I am building this channel for. If this is the kind of breakdown you want more of, you know what to do with the subscribe button. In a market fueled by emotion and noise, we thrive on data and composure. Stay patient, stay rational. The math doesn't lie, and the system is almost complete. I am the calm analyst. I'll see you in the next briefing.